Look, everyone's staring at the price chart. Everyone's checking CoinMarketCap 50 times a day. Everyone's asking when XRP is going to break out. And I get it, price is what pays the bills. Price is what makes the gains. But if you're only looking at price, you're missing the most bullish signal that XRP has flashed in years. And I'm not talking about hopium. I'm not talking about moon predictions or technical analysis patterns. I'm talking about on-chain data that's screaming institutional accumulation at levels we haven't seen before. And when you understand what this data means, when you connect the dots, you start to realize that something massive is being set up right now, while everyone else is distracted by daily candles. So let me break this down piece by piece. Because there are three key on-chain metrics that are painting an absolutely wild picture: network velocity, whale accumulation, and exchange balance dynamics. And when you combine all three, when you see how they're moving together, you start to understand why smart money is positioning aggressively right now, why institutions are accumulating while retail is scared, why this setup looks eerily similar to what we saw right before the last major XRP rally. So let's dive in, let's look at the data, and let's figure out what it's really telling us. First, network velocity. And this is huge. The XRP ledger achieved record network velocity in December 2025. Network velocity measures how frequently XRP changes hands, how active the network is, how much circulation is happening, and in early 2026, velocity spiked to 0.0324. That's the highest reading of 2025. Now, why does this matter? Because high velocity means tokens are moving. They're not sitting idle. They're being used. They're flowing through the system. And historically, velocity spikes have preceded major price moves. Because when tokens start moving at scale, it means something's changing. Demand's picking up. Liquidity's shifting. Institutions are repositioning. And here's what makes this velocity spike different. It's not retail driving it. Daily active addresses on the XRP ledger actually dropped to 38,500 in December. That's down 94% from March 2025's peak of 600,000. So retail participation is way down. But payment volume surged 140% in the same period. Let that sink in. Fewer addresses, massively higher volume. What does that tell you? It tells you that the activity is coming from larger players, institutions, whales, ODL corridors processing real payments. This is exactly the type of activity you want to see when utility is catching up to speculation. Now let's talk about whale activity, because this is where things get absolutely insane. In early January 2026, XRP whale transactions hit a 3-month high. 2,802 large value transfers in a single day. That's transactions over $100,000 each, up sharply from 2,170 the previous day. This is the highest level of whale activity in roughly 3 months, and it's not slowing down, it's accelerating. Now, when whales start moving like this, it usually means one of two things. Either they're distributing into strength, taking profits, preparing to exit, or they're repositioning for a major move, accumulating, building positions, getting ready for what's coming. And the data strongly suggests it's the latter. Because look at what whales did in December 2025. They moved 800 million XRP tokens off exchanges into cold storage and regulated ETF custody vaults. 800 million tokens. That's locking over 400 million XRP out of active trading. When whales are moving tokens into cold storage, they're not preparing to sell, they're preparing to hold, long term. And when they're moving tokens into ETF custody vaults, that's institutional-grade infrastructure. That's regulated. That's compliance first. That's the type of accumulation that doesn't reverse quickly. But wait, there's more. Whale wallets holding between 10 million and 1 billion XRP accumulated 620 million tokens in late 2025. That's in addition to the 800 million moved to cold storage. So we're talking about over 1 billion XRP accumulated by whales in a matter of weeks. And the number of wallets holding over 1 million XRP hit an all-time high of 2,700 mid-2025. 2,700 wallets, all holding at least 1 million XRP, all positioned, all waiting. And here's the kicker. While the number of mega whale wallets actually declined 20.6%, the remaining large wallets now control a 7-year high of 48 billion XRP. Consolidation. Strategic accumulation by fewer, larger, more sophisticated holders. Now, before we go any further, let me pause for a second. Because if you're watching this and you're thinking, okay, I see whale accumulation happening, but I don't know how to actually read these signals myself. how to identify when accumulation is real versus when it's distribution disguised as accumulation, then you need to check out the crypto course. Because the course breaks down exactly how to track whale wallets, how to read network velocity, how to identify when large holders are building versus when they're exiting, how to use on-chain data to front-run institutional moves instead of chasing them after the fact. Links in the description. Get access while these signals are still early. Alright, now let's talk about exchange balances because this ties everything together. Exchange balances for XRP hit an 8-year low. The amount of XRP held on centralized exchanges dropped from 3.76 billion tokens in early October to just 1.6 billion by the end of December. That's a 57% decline in less than 3 months. Binance specifically saw reserves drop from over 3 billion tokens to approximately 2.6 billion, and by early January 2026, those reserves fell even further to around 1.85 billion. 800 million XRP exited Binance alone in the first 5 days of January. And these tokens aren't showing up on other exchanges. They're disappearing from the available supply. Cold storage, custody, long-term holds. Now here's why this matters so much. When exchange balances drop, it means less supply is available for immediate sale. It means that when demand shows up, there's less liquidity to absorb it. So price moves become more volatile, more explosive. And if you combine falling exchange balances with increasing whale accumulation and spiking network velocity, you've got a powder keg. All it needs is a catalyst. One piece of good news, one regulatory development, one major partnership announcement, and with supply this tight, with positioning this one-sided, the move could be violent. And here's where institutional demand comes in. Because XRP ETFs have absorbed $1.4 billion in inflows by January 2026, 43 consecutive days of positive inflows when they first launched. Not a single day of outflows for over 6 weeks. That's institutional money flowing in at a pace that's second only to Bitcoin ETFs. And that capital is pulling supply off exchanges. It's locking it in custody. It's creating structural demand that doesn't reverse based on daily price action. These are long-term allocations by institutions that have done their due diligence, that have gotten internal approval, that are building positions over months, not days. Now let's talk about what makes this cycle different from a network metrics perspective. The XRP ledger is processing actual economic activity at scale. RippleNet processed over $1.3 trillion in volume during the first half of 2025. Transaction speeds are 3 to 5 seconds. Fees are fractions of a cent. The average cost per institutional transaction with RippleNet is $0.0011. Compare that to $32 via Swift. And the network's achieving a 99% transaction success rate even during peak congestion. This isn't theoretical. This is live. This is production. This is real economic activity happening on the network right now. And here's what's fascinating about transaction fees. XRP Ledger transaction fees have been surging consistently since 2024. Not because the fees themselves are expensive, they're still fractions of a cent, but because volume is increasing. More transactions, more network usage, more real economic activity. And when you see fee revenue increasing while price is relatively stable, that tells you the network is being used for its intended purpose. It's not just speculation, it's actual utility. Payments, settlements, cross-border transfers. The infrastructure is working, and as usage grows, as more corridors go live, as more institutions deploy ODL at scale, those fees reflect billions of dollars in value transfer. Now, let me give you some historical context because this matters. The velocity spike we're seeing now is similar to what we saw in 2024 before XRP rallied 400%. High velocity, whale accumulation, falling exchange balances, and then boom. The market caught up to what the data was showing, and the people who were paying attention to on-chain metrics instead of just price were positioned. They were ready. They made life-changing money because they understood that on-chain data is a leading indicator. Price is a lagging indicator. By the time price confirms what the data's been showing for weeks, the easy money's already been made. So where do we stand right now? We have record network velocity showing active token circulation. We have whale transactions at 3-month highs with 2,802 large transfers in a single day. We have over 1 billion XRP accumulated by whales and moved into cold storage in recent weeks. We have exchange balances at 8-year lows with 57% of supply pulled off exchanges in 3 months. We have ETF inflows of $1.4 billion, creating structural institutional demand. We have network transaction volume up 140%, while retail participation is down 94%. All of this points to one thing: institutional accumulation, smart money positioning, infrastructure being used at scale, and a supply-demand dynamic that's getting tighter by the day. Now let's talk about the Fear and Greed Index, because this is important for understanding sentiment. The Crypto Fear and Greed Index hit 24 in early January. 24. That's extreme fear territory. And you know what's interesting? Extreme fear is when smart money accumulates. When retail is scared, when sentiment is terrible, when everyone thinks crypto is dead, that's when institutions build positions, because they're not trading based on emotion, they're trading based on data, based on fundamentals, based on long-term conviction. And right now, the data says accumulate while retail is fearful. Build positions while supply is available. Position before the catalysts hit. And speaking of catalysts, let's talk about what could ignite this setup. Because you've got supply getting absorbed, you've got whales positioned, you've got network usage growing, but you still need demand to show up. You need a trigger. And there are several potential catalysts on the horizon. First, Q1 regulatory clarity, potential ETF approval decisions, the Clarity Act making progress. Each of these could bring fresh institutional capital. Second, RLUSD expansion, Japan launch in Q1, more bank corridors going live, institutional adoption scaling. Third, partnership announcements, more Fortune 500 companies adopting Ripple solutions, more banks deploying ODL, more real-world utility being demonstrated. But here's the thing. You don't need all the catalysts to hit. You just need one. Because when supply is this tight, when positioning is this one-sided, when institutional accumulation is this aggressive, it doesn't take much to move the market. One positive development, one headline, one piece of regulatory clarity, and the move could be explosive. Because there's no liquidity to absorb the buying pressure. Exchange balances are at 8-year lows, whales are holding, institutions are accumulating through ETFs, and retail is sitting on the sidelines scared. That's the perfect setup for a short squeeze, for FOMO to kick in, for price to gap higher before most people even realize what's happening. Now let me address something important. I'm not saying this moons tomorrow. I'm not promising 10x or 20x or any specific number. What I am saying is that the on-chain data is showing something significant, something that doesn't happen often. And when you combine record velocity with whale accumulation at multi-month highs, with exchange balances at 8-year lows, with institutional ETF demand absorbing supply, you're looking at a setup that has historically preceded major moves. Not guaranteed moves. Markets are never guaranteed, but high-probability moves based on how similar setups have played out in the past. And here's where risk management comes in. Because even with the strongest bullish setup, you need to know your levels. You need to know where you're wrong. Right now, support sits around 180 to 190. That's been acting as a major demand zone. If we hold above that, if we can consolidate here while accumulation continues, the setup gets stronger. But if we lose 180 decisively, if we break down and can't reclaim it, then you need to reassess. Because that would suggest distribution is happening despite what the other metrics are showing. So watch those levels. They matter. Let me talk about the difference between what retail sees and what institutions see. Retail looks at XRP and sees a price that's been range-bound for months. They see sideways action. They see frustration. They think nothing's happening. Institutions look at the same asset and see network velocity spiking. They see whale accumulation at multi-month highs. They see exchange balances collapsing. They see ODL volume growing. They see real adoption scaling. They see a supply-demand dynamic getting tighter. They see an opportunity, and they accumulate. Because institutions don't trade based on what's happening today. They trade based on what they think will happen in 3 months, 6 months, 12 months. And right now, the data suggests something significant is building. And here's what makes network velocity such a powerful signal. It's not just about tokens moving. It's about who's moving them and why. When velocity spikes alongside falling retail participation, it means institutional activity is driving the network. When velocity spikes alongside increasing transaction volume, it means real economic activity is happening. And when velocity spikes alongside whale accumulation, it means large holders are positioning for something. They're not just sitting idle, they're actively managing positions, moving tokens, building, preparing. And that preparation is visible on-chain if you know how to read it. Now let's talk about what happens if this setup plays out. If whales continue accumulating, if exchange balances continue falling, If network velocity stays elevated, if institutional ETF demand continues, if one or more catalysts hit in Q1, what does that look like? It looks like a supply shock. It looks like rapid price discovery as buyers scramble for limited supply. It looks like leverage getting flushed on both sides, shorts covering, longs getting stopped out and then re-entering higher, FOMO kicking in, retail rushing back in after being sidelined, and institutions continuing to accumulate because their time frame is longer than a few weeks of price action. But even if it doesn't play out in Q1, even if we consolidate for longer, the fundamental thesis remains strong. Because accumulation is happening, utility is growing, institutional infrastructure is being built, regulatory clarity is improving, real-world adoption is scaling. These aren't things that reverse overnight. These are structural changes that take time to fully manifest in price. But when they do, when the market finally recognizes what's being built, the repricing can be violent. Because you're not just getting speculative capital. You're getting institutional allocations based on utility and adoption. And that's stickier. That's more sustainable. That's the foundation for long-term value creation. Let me give you one more piece of data that ties this all together. The number of new XRP wallets created hit a record increase in November. 21,595 new wallets in 48 hours, the highest in 8 months. Now, some of those are retail, but a significant portion are institutional, custody wallets, ETF infrastructure, corporate treasuries, payment providers setting up ODL. This is infrastructure being built. And when infrastructure gets built at this scale, it doesn't get torn down quickly. It creates persistent demand, ongoing usage, long-term value accrual. So let's bring this all together. The most bullish signal for XRP right now isn't price, it's on-chain data. Network velocity at record highs, whale transactions at 3-month peaks with 2,802 large transfers in a day. Over 1 billion XRP accumulated and moved to cold storage. Exchange balances at 8-year lows. ETF inflows creating structural institutional demand. Transaction volume up 140%, while retail participation is down 94%. Fear and greed index at 24, showing extreme fear. And infrastructure being built for long-term utility and adoption. All of this points to institutional accumulation happening right now while retail is scared. Smart money positioning while sentiment is terrible. Infrastructure being deployed while price is range-bound. And historically, when on-chain data diverges this much from price action, when accumulation is this obvious but price hasn't reflected it yet, that divergence eventually resolves. Either the data was wrong and accumulation stops, or the price catches up to what the data's been showing. And based on the strength and consistency of these signals, based on the velocity spike and whale activity and exchange balance dynamics all confirming each other, it looks like the latter is far more probable. Now, does that mean we moon tomorrow? No. Does it mean there's zero risk? No. Does it mean you should ape in without a plan? Absolutely not. What it means is that the setup is there. The data is showing something significant. And if you're paying attention, if you're watching the metrics that matter, if you understand what institutional accumulation looks like on-chain, you can position accordingly. You can manage your risk. You can build a position while supply is available. You can prepare for what might be coming instead of chasing it after everyone else has figured it out. So stay focused. Keep watching network velocity. Keep tracking whale transactions. Keep monitoring exchange balances. Keep following ETF flows. Keep your risk managed. Keep your strategy tight. And most importantly, stop obsessing over daily price action. Because the real signal isn't the candles, it's the on-chain data. And right now, that data is screaming louder than it has in months. The question is whether you're listening. Let me give you some more context on why whale behavior matters so much. When you see 2,802 whale transactions in a single day, that's not random. That's coordinated. That's strategic. Whales don't wake up one day and all decide to move their positions at once by accident. This is planning. This is preparation. And what are they preparing for? Well, historically, when whale activity spikes like this, it precedes one of two outcomes. Either a sharp move down as they distribute into strength, or a sharp move up as they finish accumulating before a breakout. And right now, every other metric suggests it's the latter. Think about the timing. Whale accumulation is spiking while retail participation is cratering. That's not coincidental. That's whales accumulating while retail is scared, while sentiment is terrible, while everyone thinks nothing's happening. This is classic smart money behavior. Buy when there's blood in the streets. Accumulate when fear is high. Position before the crowd realizes what's happening. And the beauty of on-chain data is you can see it happening in real time if you know where to look. You don't have to guess. You don't have to speculate. The blockchain doesn't lie. Now let's talk about what's happening with institutional infrastructure, because this matters. Ripple's acquiring companies. They bought Hidden Road and rebranded it as Ripple Prime. That's a crypto-native prime brokerage. They raised $500 million at a $40 billion valuation. They're not raising that capital to sit on it. They're deploying it, building infrastructure, scaling operations. And when a company is raising money at that valuation and building that aggressively, they're preparing for significant growth. They see something coming. And their actions are backing up that conviction with real capital deployment. And here's something else that's fascinating. The XRP ledger integrated post-quantum cryptography and native smart contracts in December 2025. That's future-proofing the network. That's ensuring it can handle next-generation security requirements. And it enables direct DeFi application development on XRPL. This isn't just about payments anymore. This is about building a complete financial infrastructure. DeFi, tokenization, smart contracts, all while maintaining the speed and cost efficiency that made XRP attractive in the first place. That's powerful. That's expanding the addressable market significantly. Let me give you another piece of data that's getting overlooked. XRP Ledger daily transactions increased 8.9% in Q3 2025, reaching 1.8 million, and NFT activity saw a 51.1% rise in daily transactions, with minting up 70.8%. Now, I'm not saying NFTs are going to drive XRP's price, but what this shows is ecosystem growth, developers building, users engaging, network effects compounding. And when you have a healthy, growing ecosystem alongside institutional adoption, that creates multiple layers of demand. Not just speculation, real usage, real value creation. Now let's talk about the divergence between price and fundamentals, because this is critical to understand. XRP's price has been relatively range-bound, between 180 and 240 for months. But during that same period, network velocity hit records, whale accumulation hit multi-month highs, exchange balances hit 8-year lows, transaction volume increased 140%, ETFs absorbed $1.4 billion, institutional infrastructure got built, real-world utility expanded. All of these fundamentals improved while price stayed flat. That divergence can't persist indefinitely. Either the fundamentals roll over and price was right, or price catches up to the fundamentals. And based on the strength and acceleration of these metrics, the latter looks far more probable. And here's why this divergence creates opportunity. Because most people trade based on price, they see range-bound action and they think nothing's happening. They get bored, they move to other assets, they miss what's building underneath. But if you're watching on-chain data, if you're tracking whale wallets, if you're monitoring network metrics, you see a completely different picture. You see accumulation, you see preparation, you see positioning, and you can build your position while price is boring, while sentiment is terrible, while supply is still available. That's how you front-run institutional moves instead of chasing them. Let me talk about liquidity for a second, because this is important. When exchange balances drop 57% in 3 months, you're not just reducing supply, you're fragmenting liquidity. You're making the market thinner. And thin markets are more volatile. They move faster, they gap more. They're harder to trade in size without moving price significantly. So when demand does show up, when a catalyst hits, when institutions decide it's time to deploy more capital, they're going to move the market. They won't have a choice. Because there's no deep liquidity to absorb large orders, they'll have to chase price higher. And that creates the explosive moves that retail loves to chase after they've already happened. Now let's address the elephant in the room. What if this setup doesn't play out? What if whale accumulation stops? What if network velocity rolls over? What if exchange balances start rising again? These are valid questions, and the answer is you watch the data. You monitor the metrics. You adjust your thesis if the data changes. But right now, the data's not changing. It's accelerating. Velocity's at records. Whale activity's at multi-month highs. Exchange balances keep falling. ETF inflows continue. Every week we get new data confirming the thesis. So until that changes, until we see distribution instead of accumulation, the bullish case remains intact. And here's something most people don't think about. On-chain data is probabilistic, not deterministic. It doesn't guarantee outcomes. It tilts probabilities. When network velocity spikes, whale accumulation surges, and exchange balances collapse, you're not guaranteed a rally. But you're significantly more likely to get one than when these metrics are moving the other way. You're stacking probabilities in your favor. And over time, over many trades, over many setups, trading with probabilities on your side is what generates consistent returns. Not perfect trades, not guaranteed wins. Probabilistic edges executed with discipline. Let me give you one more example of how powerful on-chain data can be. In 2024, before XRP's 400% rally, velocity spiked, whale accumulation increased, exchange balances dropped. The data was screaming accumulation for weeks before price moved. And the people who were watching those metrics, who understood what they meant, who positioned based on the data instead of the price, those people made life-changing money. Because they were early. They were positioned before the crowd. They bought while others were scared. And when price finally caught up to what the data had been showing, they were already in profit. So where do we go from here? We watch the data obsessively. We track whale wallets daily. We monitor exchange balances weekly. We follow network velocity in real time. We measure ETF flows continuously. We look for confirmation or contradiction, and we adjust our positioning accordingly. If the data continues showing accumulation, we stay positioned or add. If the data starts showing distribution, we reassess. But we don't trade based on emotion. We don't trade based on what we hope happens. We trade based on what the data is actually showing. And right now, the data is showing one of the strongest accumulation setups XRP has had in years. And here's the final piece I want to leave you with. This isn't about getting rich quick. This isn't about finding the next 100x. This is about understanding market structure, about reading supply and demand, about identifying when smart money is positioning and why, about using on-chain data to make better informed decisions. Because at the end of the day, crypto is just supply and demand. When supply contracts and demand increases, price goes up. When supply expands and demand decreases, price goes down. Everything else is noise. And right now, supply is contracting aggressively while institutional demand is increasing. That's the signal. That's what matters. Everything else is just commentary. All right, that's what I got for you today. XRP's most bullish signal isn't price, it's network velocity spiking to record highs. It's whales accumulating over 1 billion tokens. Its exchange balances at 8-year lows. It's institutional ETFs absorbing supply. It's on-chain data painting a picture that most people are completely missing. And if you want to learn how to read these signals yourself, how to track whale wallets, how to identify accumulation versus distribution, how to use on-chain metrics to make better trading decisions, check out the crypto course, links in the description. And let's see what happens when this setup finally resolves. Because I got a feeling it's going to be one hell of a move. Stay liquid, stay ready.